Welcome to the WealthWise Show. This program is for informational and educational purposes only and does not constitute investment, legal, or tax advice. Benowitz Wealth Management is a registered investment advisor in the state of Florida. Registration does not imply any level of skill or training. Listeners should consult a qualified professional before making financial decisions. Past performance is not indicative of future results. Now let's get started with the WealthWise Show.
Welcome, guys, to another episode of the WealthWise Show. I'm your host, Derek, and today we're going to be talking about a little bit about investment strategy. What did I mean by investment strategy? Well, like being able to stay in the markets when we have market downturns while still protecting yourself. So to get today's shows kicked off, guys, this podcast and this episode is supposed to be for educational purposes only. It is not meant to be used as personal investment advice. So anything you hear, see, tickers, stocks, names, companies, blah, 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 it's educational purpose only. Do your own due diligence and research. So with that being said, let's get into today's show. And so when we think about protection, and in the sense of investing, what does that mean? Does that mean take all your money out? Does that mean just let your money sit and watch it devaluate? Or does that mean be proactive with making sure that your money is protected while still being in a drawdown? Well, of course, that's the third one. But suspense. I'm not very good at suspense. This is not a thriller or I don't know, the podcast, the girlies like with murder and all that stuff. I don't get it. But point is, not a thriller. Ideal is protection of your assets is one of the key things to becoming a great investor. Understanding what you invest in, being consistent with investing, and what was the other one? Consistency, understanding, it'll come to me. But those are the cornerstones that will make you a great investor, especially if you don't have help with like an advisor or something like that. And so how do you protect yourself then? Let's say you have $10,000 in the S&P 500 ETF, and the market's gone down 10%. So you're losing 10% of your money. What do you do? Oh my goodness, do I just let it sit? Do I put more money in there? Well, you can do both. You can let it sit and put more money in there. But you can also do what's called hedging. I don't like using the term hedging your bets because, really, technically, yes, when you're investing, there's a lot of unknowns and there is a speculative aspect to investing. But if you know exactly, why you're investing and, it's just not just pure speculative, then, you're not really betting. Unless you're, a trader. A trader is a little different than an investor. But you want to hedge your portfolio. So how do you hedge your portfolio? This little mic is touching my neck and it's making me feel uncomfortable. For those who are listening, I have a lapel mic and it's touching my neck and it's making me a little, but what is hedging your portfolio? It's something simple. It is when you put a counter to what you have planned. Meaning, if you think the market's going up and you're investing because you want the market to go up and hey, the market's going up, why not invest? Well, you can put something in your portfolio that pretty much make money when the opposite happens. And so there's tons of things you can do to make money while the market is depreciating. And so that's what I mean by protection, adding a level of protection. And this particular level of protection is not necessarily an investment because you're not investing in this because, you're not investing for the market to go down. We want the market to go up. But the ideal is to limit the depreciation. Very rarely, there's some people who can, stop the bleeding totally. But that requires a significant level of skill. But majority of the time, it just, instead of the market going down 10%, you're going down 10%. You might go down 8%. And so, that's better than 10%, And so if you're wanting to hedge your portfolio, what are some of the strategies? And so one of the strategies that is very common and very easy to get in and out of is what we call writing calls. And so I'm pretty sure I've done an episode on call options and writing calls and what options are. So go back and listen to that or watch that video. But what is, writing a call option? And so I'm not going to go too deep into options because, we have a lot to talk about. And one of the things that I don't want to do is just stick on one thing because I want to kind of encompass this in, one video, all the information. And so writing a call option is a great way because what it does is if the market is going down, since you're writing a call, meaning you are saying that, I expect the markets to go down. And when you sell that call, or when the broker sell that call, the person who's buying that call is expecting the market to go up, but you're expecting it to go down. And so the premium or the purchase price for that call, you get the premium, and that's, good. But the ideal is you really want to protect your shares. And so call option writing is ideal. I know I didn't explain that 100%. Like I said, I'm not trying to explain what calls are and options and all that stuff. That's, I did other videos in the past about that, so please go watch those. But call options or writing calls is a great way to limit your drawdown. So not only do you get the appreciation, not only do you get the premium from writing on the call, but when the markets go down, the option become basically worthless if you time it right with the expiration. And so now you get to keep your shares, you keep the premium, and now the premium you can turn into buying more shares. So that's a nice simple strategy. Look up, if you really want to know about writing calls, look up on YouTube about writing calls. Tons of videos. Like I said, I did videos. There's tons of videos out there for that. So the next thing is not just writing call options. You can do puts as well. And so writing call options are going to be the safest bet because you already own the shares, and you're not really, the only thing you lose out on if the market's going to go up and you sell your shares. But you get the proceeds from that, and you still keep the proceeds of the premium. So that's usually more on the safer side of strategies. But another one is doing puts. Now puts are a little bit more, I would say you can actually lose money on your puts. And the reason I say that is because let's say you buy a put and the market keeps going up, well, your put can go worthless. But remember, I said we're not investing using these strategies. These are just for hedging, making sure we have some protection. So if you do buy a put, understand that whatever you purchase that put for, you're okay with it going to zero because you're just protecting yourself for just in case. Now, if the opposite happens, you're gonna, gain some money, which is gonna help you with your drawdown. But, if you're wrong and it might continue to go up, understand that you're okay with losing that amount of money. So that strategy is more, I would say, for people with a little more sophistication, a little more sophisticated with understanding how trading and markets work. Not really for the beginners, but it is a great strategy to learn if you really want to do investing for real. And then the next one is going to be, it's going to be the top of the risky level, which is going to be inverse ETFs. And so what are inverse ETFs? So basically, they are ETFs. So let's say the SP 500 ETF. Well, that goes up. So an inverse ETF, what does that do? that goes down. It does the inverse of what the index is doing. And so usually you can buy shares, which is make it easier to get it in and out of. The reason why I say it's risky, because a lot of times they're highly leveraged. And leverage is when, you know what leverage is. I don't have to explain that. If you don't know what leverage is, then go back to the drawing board. But it's usually really highly leveraged. And the reason why that's risky is because let's say the market go down 5%. Well, a leverage ETF might go down 8%, you know, and then vice versa. If the market goes down 5%, did I say that right? So if the market goes up, let's say 5%, then the inverse ETF will go down like, 8%. And then the inverse happens. If the market goes down 5%, the inverse ETF may go up 8%. And the reason why I feel like that is a viable strategy for the people who are into trading, because it's like a share, you can get in and out of. Usually they're really inexpensive, so you really don't have to purchase, use a large dollar amount. And unlike an option, yes, reverse ETFs can go to zero, but the likelihood of it going to zero in that amount of time is low. And so you can, instead of like losing all your money on the put, for example, you can still have some money left over after you sell your shares of the inverse ETF. And so those are the three strategies from beginner, middle, and expert. Are, I don't know what is expert and a beginner. What's the middle of that? I don't know. Comment down below. But yes, those are the three strategy levels that you can use to give yourself some protection. And of course, there's tons of others. I just want to keep this video simple. You got futures, you got assets that are oppose each other, like kind of like inverse of each other. But instead of like an inverse ETF, it's like, a different asset that just goes up when this asset goes down. There's like tons of stuff you can do, tons of strategies. That's one of the reasons why I love the market so much, because it's so many things that you can do, like mix and match, and you can constantly mix and match. It's not like, one shoe fits all. If it works for me, it works for me. If it works for you, it works for you. And when I say that, I mean, like, if you do a strategy, like you do call options or write calls, that could really work for you, but it could not work for someone else. So they might do inverse ETFs, and that might not work for them. So they might just do puts, that might not work for them. So they might just, short the futures market. That might work for someone else. So they, go to gold or Bitcoin or something like that. There's so many things that you can do to fit your personality and your style of investing. And so I really wanted to hammer home on the point of, one, being consistent with your investing, but you don't just have to let your portfolio go down. Like, your portfolio will rebound, over some time. So I'm not saying like if you don't do nothing, it's the end of the world. But if you're one of those people who want to be a little more proactive, who just don't want to set and forget it, having hedges in your portfolio for the appropriate times is important. Now that brings me to my next thing, the appropriate times. Well, when do you put it in a hedge and when do you take it off? Well, that's up to you. I know my strategy. I know my strategy that I take care of, but I can't tell you when and when not to do something, because I don't know when, you could be watching this in the very far future, very far. You can be watching this in the near future or far future or whatever, and something else is happening. I don't know. So it's best not to take strategies from YouTubers or podcasters. And when I say strategies, I don't mean like, call option strategies. I'm talking about like, hey, when you see the market do this, that's when you do this. It's like, things happen. Yeah, the market kind of does the same thing constantly, but there's a lot of new territory that the market's been in lately. And I feel like that's going to be a constant new territory constantly. And so, when to buy, when to sell, that's totally up to you and your gut and your plan. But at least you can do something about it. So yeah, that's pretty much it, guys. I appreciate you listening to this week's episode. I greatly appreciate you guys, and I look forward to continuing to assist you with some education. And until next time, guys, stay wealth wise.